The United States has announced new tariffs on Canada and Mexico, two of its largest trading partners. These tariffs will have significant consequences for North America and the global economy. Understanding the reasons behind these tariffs, their impact on industries, and the potential global effects is crucial. The US is imposing these tariffs to address trade imbalances and concerns over foreign subsidies. Tariffs are taxes on imported goods used to protect domestic industries or negotiate better trade deals. The US government believes that Canada and Mexico have unfair advantages in certain industries, prompting these measures. Additionally, some policymakers argue that these tariffs will encourage American companies to shift production back to the US, reducing dependence on foreign suppliers and boosting domestic job growth. However, opponents argue that such protectionist policies can backfire by increasing costs for American manufacturers and consumers alike. Canada and Mexico, being top trading partners of the US, will face serious economic challenges due to these tariffs. Trade between these three countries exceeds $1 trillion annually. The tariffs will increase the cost of exports from Canada and Mexico, making their goods more expensive in the US. This could reduce sales, lead to job losses, and slow down major industries such as auto manufacturing, agriculture, and steel production. Canadian and Mexican companies may be forced to seek alternative markets, potentially strengthening their trade ties with Europe and Asia, reducing reliance on US trade. The automotive industry is one of the most vulnerable sectors. The North American supply chain is deeply integrated, with car parts crossing borders multiple times before final assembly. Higher tariffs will increase production costs, leading to more expensive vehicles for consumers. Automakers may need to rethink their supply chains, potentially shifting operations to other regions to mitigate losses. These tariffs will not only impact Canada and Mexico but also the US economy. Higher import costs will raise production expenses for American companies that rely on raw materials from Canada and Mexico. This could result in price hikes for essential products such as cars and groceries. Businesses may struggle to remain competitive, potentially leading to layoffs and economic contraction. Small businesses that rely on affordable imports may be particularly affected, as they may not have the resources to absorb higher costs, forcing them to pass expenses onto consumers or reduce operations. Increased costs for raw materials like aluminum and steel could further squeeze profit margins for industries dependent on these materials. The global economy will also feel the effects of these trade restrictions. Disruptions in trade between the US, Canada, and Mexico could cause supply chain issues worldwide. Countries relying on North American goods may experience shortages and increased prices. Other nations may respond with their own tariffs, escalating the situation into a broader trade war. Investors and markets are reacting with concern, fearing economic instability. Stock markets could see increased volatility, and multinational corporations with operations spanning North America could face difficult decisions regarding production and distribution. The agricultural sector is expected to be particularly impacted. Many American farmers rely on exports to Canada and Mexico, and retaliatory tariffs from these countries could severely limit market access. This could result in surplus goods within the US, causing prices to drop domestically while farmers struggle to make profits. Meanwhile, consumers in Canada and Mexico may have to deal with increased food prices, as alternative suppliers may not be as competitive in cost or quality. Agricultural associations have already voiced concerns about these trade restrictions, warning of devastating economic losses if farmers lose access to crucial markets. Energy markets may also experience fluctuations. Canada is a significant supplier of oil and natural gas to the US, and trade restrictions could disrupt existing energy trade agreements. This could impact fuel prices, transportation costs, and industrial production, contributing to broader economic uncertainty. A disruption in energy trade could also have environmental implications, as shifting to alternative sources might increase reliance on less sustainable options. Beyond North America, these tariffs could alter global trade relationships. Countries like China and the European Union might take advantage of strained US-Canada-Mexico relations to strengthen their trade partnerships with these nations. If Canada and Mexico begin prioritizing trade with Europe and Asia, the US could lose influence in the global economic landscape. Other nations closely watching this situation may also reconsider their reliance on US markets, potentially shifting alliances and investments. The future remains uncertain. These tariffs may lead to renegotiations of trade agreements like the USMCA. Canada and Mexico could retaliate with their own tariffs, further straining economic relations. Alternatively, diplomatic efforts might result in compromises to ease tensions and prevent further economic damage. The coming months will be critical in determining whether North America moves toward trade resolution or deeper economic uncertainty. The US decision to impose tariffs on Canada and Mexico will have widespread consequences. These policies will affect industries, businesses, and consumers, with potential long-term global repercussions. Observing how negotiations unfold and whether further actions are taken will be essential to understanding the future of North American trade. As trade relationships evolve, companies and governments must prepare for a shifting economic landscape that could redefine global commerce in the years to come. The full impact of these tariffs may not be clear for years, but their implications will be felt across economies, industries, and everyday life.